Welcome to TalkTickers. We're your go-to for getting straight to the heart of earnings calls.
We cut through the jargon and give you the insights that matter.
Today, we are doing a deep dive into Datadog's second quarter 2025 results, ticker DDOG.
That's right. We've gone through the report, the call, all the details really, so you get the full picture. Our mission is to make this dense info feel more like a conversation.
Exactly, giving you those aha moments.
Okay.
So let's jump in. The snapshot for Q2, honestly, very strong.
Oh, definitely. Datadog really delivered. They didn't just meet expectations, they significantantly beat them, top and bottom line.
Yeah, non-GAAP EPS came in at $0.46. The consensus was, what, $0.41? So a nice 5-cent beat there.
Right. And revenue hit $827 million. That's a robust 28% jump year over year. Analysts were looking for more like $791 million.
So big beats across the board. Operationally, things look really good.
They do. And you see it in other numbers, too. Free cash flow, for example, was solid, $165 million.
Which translates to a 20% margin, right? That's quite healthy.
Very healthy. Billings also looked good, up 20% year over year to $852 million. So operationally, you can't really argue with the quarter.
But, and this is the interesting part, the market reaction was, well, a bit weird.
Yeah, it was. There was this initial pop in pre-market trading. I think it was up over 8% at one point.
Something like that.
Yeah.
But then by the end of the actual trading day, it mostly fizzled out, ended slightly down, I believe.
Right. Which suggests, there's maybe more to the story than just these strong operational numbers. Investors are weighing other things.
Definitely worth digging into.
Yeah.
So let's unpack it. Where do we start? I think the big headline has to be AI, right?
Absolutely. Datadog themselves called it out as a primary growth driver. They talked a lot about this AI native customer group.
And the usage growth from that group was apparently much stronger than they even expected.
Much stronger. And it's becoming a really significant chunk of their business. It's now about 11% of Q2 revenue.
Wow, 11%. Wasn't it like 8% last quarter?
Exactly. And only 4% a year ago. So rapid growth. And get this, that cohort alone contributed about 10 percentage points to their overall year-over-year revenue growth.
Okay, so that's huge. No wonder the CEO, Olivier Palmer, sounded so bullish.
Extremely bullish. He called AI a significant tailwind, even a generational growth opportunity.
And he said, we're just getting started. That definitely signals big ambitions.
It does. And you saw that reflected in their innovation pace, too. Remember their DAS conference in June? They announced something like over 125 new products and features.
A lot of them focused on AI, presumably.
A huge focus on AI. They're not just monitoring AI, they're embedding AI into their own tools, like these autonomous AI agents they announced.
Right, the Bits AI agents for SRE, dev, and security.
Exactly. Bits AI SRE for handling incidents, Bits AI dev for fixing production issues, Bits AI security analyst for triaging threats. These agents are designed to actually do things, not just report data.
That sounds like a pretty big leap, almost like virtual team members.
It kind of is. And they're thinking about the human side, too. Did you see the AI voice agent?
For incident response. Yeah, tell me about that. How does that work?
Well, imagine there's a critical incident. This agent lets people get quick updates verbally, on their phones, hands-free. It's about getting info to the humans faster when things are, hitting the fan.
Okay, that makes sense. Speeding up the human response loop. What about securing the AI models themselves? That seems like a whole new challenge.
It is, and Datadog's rolling out specific tools for it. Things like a sensitive data scanner for LLM prompts to stop people accidentally feeding sensitive info into AI model.
Oh, interesting. Like checking what users are typing into ChatGPT or similar tools integrated into workflows?
Precisely. And they're tackling other AI-specific attack vectors, too. Yeah. Prompt injection, model hijacking, data poisoning, supply chain attacks on AI components. They seem to be thinking ahead about the security risks.
So securing the inputs, the models, the whole pipeline. How do they actually observe all this complex AI stuff? GPUs, agents, models?
Yeah, it gets complicated. They're aiming for end-to-end observability. So that includes things like GPU monitoring, tracking the hardware and AI agents console to manage those bits agents we talked about.
Okay.
And even ways to observe the LLMs themselves, understand their performance, visualize how these agentic flows work, plus integration with third-party agents like OpenAI Codex through their MCP server. It's becoming a central hub.
Makes sense. A single pane of glass for all things AI ops. Now, beyond AI, which is clearly huge for them, Their core platform strategy seems to be firing on all cylinders, too.
Oh, definitely. The multi-product adoption numbers are still climbing steadily. 83% of customers use 2 or more products. That's standard now.
But the deeper adoption is what's impressive, right?
Exactly. 52% are using 4 or more products now, up from 49% last year. 29% using 6 or more, up from 25%.
And 14% using 8 or more products. That was 11% a year ago. That shows serious platform stickiness.
It really does. Customers are clearly buying into the value of having everything integrated rather than juggling, a dozen different tools.
And that security suite milestone is pretty significant, too. Over $100 million in ARR.
Yeah, and growing fast, mid-40s% year over year. That's a major success story for a newer part of their portfolio. It shows they can successfully expand into adjacent markets.
They also highlighted some really impressive customer wins and expansions. Any standouts?
Well, the scale on some is just massive. There was that multi-year expansion with a large bank worth over $60 million total contract value, expanding to 21 Datadog products. 21.
Wow. And wasn't there one with an insurance company that actually quantified savings?
Yes. A leading U.S. insurer extended their 8-figure deal, adopted 19 products, and they estimated saving over $9 million a year just on incident response because of Datadog.
That's a powerful ROI story right there.
Absolutely. And then there's the consolidation angle. That media conglomerate expansion, nearly 7 figures annualized, 21 products again. But the kicker was they replaced over 100 existing observability tools.
100 tools. Just imagine the complexity they were dealing with before.
Right. That really speaks volumes about the appeal of a unified platform. And they had other big wins too, like a major Brazilian e-commerce player and a U.S. retailer's delivery app, both consolidating tools onto Datadog.
Plus, that flex-frozen tier for logs seems like a smart move addressing long-term storage costs.
Definitely. Letting customers store logs for up to 7 years and search them without rehydrating, that tackles a major pain point around compliance and historical analysis costs. It's economically savvy.
Okay, let's talk efficiency. Gross margin actually ticked up slightly, didn't it, to almost 81%.
Yeah, 80.9%, up from 80.3% the previous quarter, which is impressive given their growth investments.
How are they managing that?
It comes down to engineering efforts on cost savings and, interestingly, using their own products, dogfooding, as they call it, to optimize their internal cloud infrastructure.
So they're proving the value of their own tools by saving themselves money.
Pretty much. But they're not just cutting costs, they're also investing heavily. OpEx grew 30% year over year.
Where's that investment going? Primarily R&D and sales.
Exactly. Ramping up hiring, significant spending on AI training and inference. They mention their Toto for National model for time series, forecasting and building out their sales capacity, especially internationally, where they see more room to grow.
Makes sense. Investing for future growth while optimizing current operations. They also launched in AWS Sydney, right?
Yeah, full product suite now available there. That's key for tapping into the Australian and New Zealand markets, especially regulated industries needing local data residency.
Plus getting added to the S&P 500 back in July. That helps with visibility.
For sure. And the 5th straight year as a leader in the Gartner Magic Quadrant for observability doesn't hurt either. Lots of validation.
Okay, so bringing it all together for investors. We have the long-term trends, cloud migration, digital transformation still strong, and now AI is layering on top as this potentially massive accelerant.
Right. But then you look at the guidance they issued, and it feels, well, cautious.
Yeah, that's the word. Q3 revenue guidance is $847 to $851 million. EPS, $1.44 down to terrific 146 cents. And the full year is $3.304 to $3.322 billion revenue, $1.80 to $1.83 EPS. Given the Q2 beat, that doesn't scream massive acceleration ahead.
It doesn't. And the CFO, David Obstler, basically addressed this. He acknowledged potential volatility from that fast-growing AI native cohort.
The optimization risk concern.
Yeah.
The idea that these big AI users might eventually figure out how to use Datadog more efficiently, like happened with some early cloud users.
Exactly. They learn lessons from those past cycles. So even though the AI cohort is growing like gangbusters now, they're building in some caution, some buffer for potential optimization down the road. They didn't quantify it, but the conservatism is there.
It's prudent, I guess, managing expectations, but they are expecting margins to hold up.
Yeah, non-GAAP operating margin guidance for Q3 in the full year is around 21%. That's a slight improvement from Q2's 20%, driven by those ongoing cloud efficiencies. So discipline on costs remains.
And competitively. They seem pretty confident.
They describe the environment as steady. Mention names like Grafana, Chronosphere. But Datadog's pitch is really about the unified platform, the pace of innovation, especially with AI, and the economic model letting them reinvest heavily in R&D to keep expanding.
Okay, so let's revisit that market reaction again. The initial plus 8% pop fading to maybe 0.4% by the close. Why do you think that happened, given the strong quarter?
It's likely a mix of things, right? Broader market nervousness, maybe some investors were positioned for an even bigger beat or stronger guidance, and there was that overhang from prior analyst notes, like the Guggenheim downgrade mentioning OpenAI optimization risk.
So some folks might have just used the good news as a chance to sell into strength, locking in profits while that optimization question mark still lingers.
Could be. It highlights this tension, fantastic current performance driven by AI versus this lingering uncertainty about how sustainable that hypergrowth from AI customers will be long term.
All right. So that brings us to our not financial advice segment. Given this backdrop, great quarter, huge AI potential, but this shadow of optimization risk, how might an experienced investor think about playing the next earnings release?
Okay, yeah, and let's stress this again. This is purely a thought experiment for informational and entertainment purposes,
Okay.
not financial advice. Please do your own research.
Absolutely. Full disclaimer. So what's the idea?
What you could consider a strategy that plays on that exact tension, that binary outlook. Maybe a long strangle for the Q3 earnings in November 2025, but with a specific focus.
A strangle, okay. Buying both a call and a put.
Right, but with a twist. You lean into the AI narrative, but also hedge that optimization risk. So maybe you buy a November $150 call.
Yeah.
That's your bet that the AI story continues, optimization fears prove overblown, and the stock rips higher.
Okay. Betting on the upside, the generational opportunity narrative winning out.
Exactly. But at the same time, you buy a November $120 put. That's your protection. If one of those big AI customers does hit the brakes on spending, or if macro bites harder and the stock sells off sharply, the put could pay off.
So $150 call and $120 put. That's a pretty wide spread between the strikes.
That's the wild part. It's not just betting on volatility, it's betting on a big move driven by a decisive shift in sentiment around AI growth versus optimization risk. The idea is the market either fully embraces the AI tailwind, sending it way up, or reacts very negatively to any sign of slowing, pushing it down significantly. Either way, a big move makes the wide strangle potentially profitable.
Interesting. So it's a play on a very polarized outcome, reflecting the current debate around the stock.
Precisely. A way to potentially capitalize on whichever way investor sentiment breaks decisively after the next earnings report. Again, high risk, just an idea.
Got it. So wrapping things up, Datadog's Q2 was, operationally speaking, very strong. Revenue, EPS beats, solid cash flow.
Driven significantly by existing customer growth and this accelerating tailwind from AI native customers. Innovation is rapid, especially around AI observability and security.
Management is clearly confident long-term, but the near-term guidance reflects some caution about potential, though currently unseen, optimization from large AI users.
And that caution, combined with macro factors and maybe some pre-earnings positioning, led to that muted market reaction by the end of the day, despite the strong results.
As always, remember everything we've discussed here on TalkTickers is for informational purposes only. It's definitely not financial advice. We always encourage you to do your own homework.
Absolutely.
So here's a final thought for you to chew on. That AI native cohort is growing incredibly fast right now. How long can it keep up that pace before optimization really starts to bite? And what happens when or if that generational growth opportunity moves beyond the early adopters and hits the mainstream enterprise? Where's the next big inflection point for Datadog?
Definitely the key question to watch going forward, a fascinating dynamic.
Indeed it is. Thanks for joining us for this deep dive on Datadog. We'll be back soon with more insights.